What if I told you that the single most commercially advanced autonomous vehicle operation in the world doesn't belong to Tesla? Right now, on the 4th of July, 2026, as millions of Americans celebrate their national holiday, a quiet revolution is unfolding on the roads of San Francisco, Los Angeles, and Phoenix, and most retail investors are still not paying attention. Tesla grabs the headlines. Elon Musk makes the noise. But when it comes to actually putting fully driverless vehicles on public roads and charging real customers real money for real rides, one company has been doing it longer, more safely, and more profitably than anyone else. Today, we're going to name that company, explain exactly why it deserves a place in your portfolio, and make the case that right now, in July 2026, it may represent one of the most compelling autonomous vehicle investments available to British and international investors alike. The autonomous vehicle sector has matured dramatically over the past 18 months. Tesla's full self-driving software reached version 14 late last year, with early testers describing it as genuinely impressive, a marked leap forward from previous iterations. Tesla also beat revenue expectations in its first quarter of 2026, demonstrating that the core electric vehicle business remains resilient. However, there is a critical distinction that investors often blur. Tesla's FSD is a driver assistance system that still requires a human behind the wheel and ready to intervene. It is not, legally or technically, a fully autonomous system. Meanwhile, the company we are spotlighting today has been operating with no safety driver whatsoever, a so-called Level 4 autonomy, in multiple major American cities, picking up paying passengers around the clock. That gap, between supervised assistance and genuine autonomy, is commercially enormous. One model monetizes miles driven under human supervision, the other can, in theory, scale a fleet of vehicles with zero marginal labor cost per trip. That is a fundamentally different business. The company we are recommending today is Alphabet, the parent corporation of Google, listed on the Nasdaq under the ticker Google, and specifically its autonomous vehicle subsidiary, Waymo. Now, some of you may push back immediately. Alphabet is a technology conglomerate worth trillions of pounds in market capitalization. Surely Waymo is just a rounding error on their balance sheet? That framing, however, is precisely why this opportunity exists. The market largely values Alphabet on its advertising revenues, its cloud computing division, and its AI infrastructure. Waymo is effectively being carried along at little to no premium. Yet Waymo has been commercially operational since 2020, has now completed well over 20 million fully driverless passenger miles, and has expanded its paid Robotaxi service across multiple cities. In early 2026, Waymo also began scaling its operations in new urban markets. Crucially, Waymo recently secured a substantial external funding round, attracting major institutional investment, a signal that sophisticated money sees significant standalone value in the business that the public market has not yet fully priced in. Three developments over recent months have materially strengthened the bull case for Waymo specifically. First, its safety record has continued to improve. Independent analyses comparing Waymo's incident rates against human-driven vehicles in equivalent urban environments have consistently shown Waymo performing at a significantly lower collision rate, a statistic that is not just good public relations but the single most important regulatory unlock for expanding into new cities and eventually new countries. Second, the competitive landscape has shifted in Waymo's favor. Several rival programs that were burning enormous capital, some backed by well-known automakers, have quietly wound down or severely curtailed operations since 2024. This consolidation has left Waymo with a cleaner runway. Third, Waymo's commercial partnership with Uber, through which Waymo vehicles are now bookable directly through the Uber application in select markets, has dramatically accelerated its demand-side reach without Waymo needing to build its own consumer-facing booking infrastructure from scratch. That is a capital-efficient model that many analysts have underappreciated. For investors today, the implications are tangible and near-term. Alphabet's share price, while it has performed strongly as an AI and cloud story, has not seen a significant re-rating on the basis of Waymo's commercial progress. That means if you are buying Alphabet shares right now, you are acquiring one of the world's most advanced autonomous driving operations at what many analysts would argue is a deeply discounted implied valuation relative to its standalone potential. Compare this to Tesla, whose share price has historically commanded a premium that reflects not just current vehicle sales but enormous anticipated future revenue from full autonomy, Robotaxi, and energy products. Tesla is priced for a version of the future where it wins. Alphabet, through Waymo, is priced for a version of the future where the market is still waiting to be convinced. For a contrarian British investor looking for asymmetric upside in the autonomous vehicle space, that pricing discrepancy is precisely where opportunity lives. Furthermore, Alphabet's core business provides a financially robust cushion. You are not betting everything on a single technology timeline, as you would be with a pure-play early-stage AV startup. Intellectual honesty demands we address the risk squarely. Waymo is not yet generating the kind of revenue that would move the needle on Alphabet's overall financial results. Scaling a Robotaxi fleet is enormously capital-intensive. Vehicles, sensors, mapping, maintenance, and insurance costs are all substantial. Regulatory risk is real. A high-profile incident involving a Waymo vehicle, however rare, could trigger city-level bans or federal scrutiny that slows expansion dramatically. Tesla should not be dismissed either. If its FSD technology matures to the point where it achieves regulatory approval for unsupervised operation, Tesla's installed base of millions of vehicles on the road globally becomes an instant commercial fleet overnight, a scaling advantage that Waymo, building its fleet from the ground up, simply cannot match in speed. And of course, Alphabet itself faces its own headwinds: ongoing antitrust scrutiny in both the United States and Europe, competitive pressure in the advertising market, and the broader macroeconomic environment all affect the parent company's share price regardless of Waymo's performance. Looking at the near-term trajectory as of today, the evidence points in a consistent direction. Waymo is expected to continue its city-by-city expansion across the United States through the remainder of 2026, with credible reporting suggesting that further international markets, potentially including Japan and the United Kingdom, are under active evaluation for medium-term entry. If a British or European launch were to materialize, the reputational and financial impact would be significant. On the technology side, the integration of Google DeepMind's latest AI research into Waymo's driving stack is an under-discussed catalyst. Alphabet's AI capabilities, developed through Gemini and other programs, feed directly into Waymo's ability to handle complex, unpredictable urban scenarios. This internal compounding advantage is difficult for competitors without a world-class AI research division to replicate. Analysts covering Alphabet have begun assigning higher probability to Waymo achieving a standalone valuation event, either a partial spin-off, a public listing, or a major strategic partnership, within the next 2 to 3 years. Each of those scenarios would crystallize value that currently sits invisible on Alphabet's balance sheet. Let us bring this together clearly. Tesla is an extraordinary company, and dismissing it entirely would be a mistake. But if you are an investor seeking exposure to the autonomous vehicle revolution in July 2026, and you are choosing between Tesla, priced for a future it has not yet delivered, and Alphabet, which owns an already operational, commercially proven, safety-leading autonomous vehicle platform that the market is still substantially undervaluing, the calculus deserves serious thought. Waymo is not a concept. It is not a slide deck. It is not a promise made on a stage. It is a fleet of vehicles operating in real cities, collecting real fares, generating real data, and compounding a safety and technology advantage that took a decade to build. Alphabet gives you that asset, plus one of the most profitable technology businesses in human history to support it. That combination, operational AV leadership wrapped inside a financially fortress-like parent company, is, in this analyst's view, genuinely incredible. As always, this video is for informational and educational purposes only and does not constitute financial advice. Do your own research, consult a qualified financial advisor, and invest only what you can afford to lose. But if the autonomous vehicle future is coming, and the evidence strongly suggests it is, Alphabet may well be the smarter road to take.